While things are starting to quiet down a little bit for earnings season for many sectors, it's about to heat up for Canada's banking sector. Over the next couple of weeks, we're going to start talking about the big Canadian players reporting their quarterly results. And at a time when the market conversation is broadening out to talk about other sectors, how are investors going to feel about investing in financials? Because we haven't talked a lot about the group this year, but you can find plenty of names that have had some very interesting performance. Here's a look at, for example, some of the comparison charts. One name we wanted to flag, Hartford Financial, out of the insurance sector in the United States, which has had some great performance versus the market this year. It's actually a stock that our next guest has had an eye on it and sees as a name that could have some further gains from here. I want to bring in Liz Miller. She's president at Summit Place Financial Advisors and one of our great regular guests. Liz, it's great to see you. We're talking a lot about where investors are going to feel comfortable putting their money going forward. How do financials fit into that picture from your perspective?
So as we look forward, I think investors are coming out of this summer focused entirely on our Federal Reserve and rates coming down. We've seen rates start to come down in other parts of the world. We've got all the economic data that suggests, cooling in our environment here. And so the question is, where do you invest as rates come down? And we've seen that move in our market all year. We expected lower rates going into the year. The Fed sort of pulled back. We saw that trade in the market. So going into the fall and going into September, financials are a great way to play lower interest rates. It flows through a lot of parts of their balance sheet. They don't have to pay as much out on these money market funds that they're paying. They can be sticky, bringing loan rates down. But the real story is that banks are sitting on huge balance sheets, are as insurers like a Hartford, where those bonds have really been beat up. We saw that financial stress in our bank system, over the past year. As rates come down, all of those bonds are worth a whole lot more, and we see a lot of upside for the financial sector from rates coming down.
And it's interesting, this stock we wanted to highlight because you talked with us about it earlier this year when everybody seemed to be talking mainly about technology. It's had a great run. It's up, I think, more than 35%. So that's easily going to beat a lot of the traditional metrics of the market. What do you think the conversation around financials is now, whether it's insurance players or what have you? I mean, it still feels like the dominant conversation is about what's going to happen with tech from here. But I guess, does that spell an opportunity if fewer people are talking about financials for somebody like you?
It does spell opportunity. When we look at the market from the previous peak, which was basically December 2021 to today, the only sector that is up is tech. And it's up nicely, and we have tech exposure, and we think everybody should. But it is really telling how almost every other sector has barely round-tripped, and that's now over 2 years. So we're looking at sectors that still have plenty of upside. Financials have started to move a little bit, and as we've said, they're really a core interest rate play now. A lot of them are very strong companies. Hartford has had this great run because it's already benefited from higher premiums that it's been able to charge. Over half its business is what we traditionally called the property and casualty. We've had a lot of problems in the United States with natural disasters. It's really laid the groundwork for insurers like Hartford to raise those premiums. So that was number one in their benefit that we've already seen, as you just commented. But now you have lower interest rates to that, and there's yet another leg up to come in financials.
Okay, I want to talk about another stock that you've highlighted before. It's called Fortune Brands. We had a conversation earlier this week with another guest about what to watch in an environment where interest rates come down. And the message there was, well, keep an eye on companies that are associated with the housing sector. Now, the market this morning seems a bit mixed on some reaction to the latest housing data. But how are you thinking about investing in the trend on interest rates when it comes to housing-related stocks? And how would a Fortune fit into that conversation as well?
So Fortune, we talked about earlier this year on this same expectation. It's taking a little longer, but still good results coming out of the company. This morning's housing starts were a disappointment, down double digits over last year. But hidden in that report was that multifamily construction is up double digit. What we take from this is that it is all about mortgage rates. Mortgage rates now about 6.5% in the United States. If we can break that 6% as rates come down and you get a magical 5, there's something very psychological in front of that, and we really think single housing is going to pick up. The report this morning confirmed that construction is still going. Builders are making important decisions about where the demand is. And with high mortgage rates, the demand for the moment is not in single family. But multifamily still will help a company like Fortune Brands. They make a mix of things from outdoor weather goods to kitchen cabinets to home security. So this really is sort of a tangential way and inexpensively to get some exposure to what will probably be an accelerating construction market in our mind.